Hello, everyone. Welcome back to another episode of Signal or Noise. Charlie Bilello here. Peter Mallouk joining me. A lot to talk about, Peter. Episode 30. I'm going to quickly run through the topics here. This is a big one, and we often talk about rebalancing into the stock market when it goes down and taking money away from the bond side. Here I'm going to ask, is now a good time to rebalance in the other direction? Number two, the allure of upside with little downside. This is the holy grail, essentially, of investing that a lot of people seek out, and there's money pouring into a lot of funds chasing this concept. Number three, where have all the good stocks gone? Interesting thing where the number of funds continues to go up, but the number of stocks in the U.S. stock market continues to go down. Number four, Powerball investing tragedy, just a sad case of a situation where the investments were not made in the best interests of this foundation. So we'll run through that. And number five, signal or noise, small cap surge. And we'll talk about quickly also one of the best starts to a year in history for the S&P 500, whether these are a signal for the market or noise. Okay, Peter, let's start out with the rebalancing question. Is now a good time to rebalance? Here's the backdrop. S&P 500, 38 all-time highs already this year. It's kind of crazy. I keep coming back to that January show where you and I had, where we hit that first all-time high of the year. And thank goodness we said, not a signal, definitely tends to be followed by more all-time highs, but certainly this is way more than I expected, than you probably expected. We're on pace actually for the second most all-time highs of any year in history, only trailing 1995. And if you look at the S&P 500, peak price to peak earnings ratio here, we're at that highest valuation level since 2000. And look at the last 5 years here, Peter. 102% for stocks for the U.S. stock market. That's about 15% annualized. And the bond market is that dark blue line there, flat over that period of time. And if you look at the bond market, you're still 9% below its previous peak from 2020, while the S&P 500 is hitting all-time highs, it seems like every single day this year. So here's the question, Peter. If you have a balanced portfolio, let's say 60% stocks, 40% bonds 5 years ago in July 2019, well, now, because of those gains in the stock market and because bonds have been flat, your portfolio, if you did nothing, would be 75% stocks, 25% bonds. What would you do in this situation for the average client? Let's assume their risk tolerance hasn't changed. They're still kind of a 60-40 investor in terms of their tolerance, but now they have a very different portfolio.
Right. So I'd go back to the financial plan and basically say, look, where am I? What am I trying to do? How much money do I need to cover the short run? And make sure you have enough bonds to do that. If the answer is still 40%, yeah, you should rebalance. The idea of rebalancing is you're not making decisions about when the stock market's too high or low, or when the bond market's too high or low, or even sub-asset classes between US and international, or large cap and small cap. You're basically saying, I have a personal plan. I've got a personal risk tolerance. I've got personal goals. I have an allocation that aligns with those. And when the allocation gets out of whack, I'm going to rebalance. And what it forces you to do is sell things that are higher than normal and buy things that are lower than normal. And so it imposes discipline on the portfolio too. So in a world where nothing's changed, which is, not the world we're in, yes, just with that information, I would rebalance. And, we talk about the all-time highs this year, just boom, boom, boom. But like we talked about coming into the year when the first one happened, all-time highs are pretty normal. They happen about once every 19 trading days. So very, very normal. We're on a pace much, much higher than that. But it is not crazy to expect when we see new all-time highs, it's not totally shocking. It's just the speed at which they're happening now.
Yeah, we're doing it, Peter, just for reference, one every 19 is the historical average. We're doing one every 3 so far this year.
It's an absolutely crazy run here, yeah.
Way bigger. Okay, so here's the other thing for people to think about when you're talking about rebalancing. What a lot of people say, well, is it going to enhance my returns? And when we look at the other situation, we talked about a lot 2020 or periods like 2008, 2009, when your stock, it was the opposite direction. Your stock portfolio had reduced greatly in terms of its percent. Your bond portfolio went up, and taking from the bond side, adding to the stock side at that period of time was very tough to do. But if you did it, it was additive returns. And that makes sense because in the long run, stocks outperform bonds. Here, different situation, right? If you just held this portfolio over time, didn't do anything, you probably will have, let's say over the next 20 years, a better return if you do nothing here, right? So it's not a question of returns, it's really a question of risk. So as you said, if you need that 40% in bonds, whether it's to sleep at night or simply you're going to be using that money in the next few years, that's a good reason to do it. But don't view it as it might be helpful returns. Let's say you do it tomorrow and then there's a big crash in the stock market and then you go back, you can rebalance back. And yes, that will be helpful, but that shouldn't be the expectation going in. Is that the right way of thinking about it?
Exactly right. Exactly right.
Okay, so we put that to bed. If you have a big percentage in stocks, you're not comfortable with that percentage in terms of you can't sleep at night. If there was a big decline or you need that money, now doesn't seem to be a bad time to rebalance. And I know you're not a big proponent of just rebalancing for the sake of rebalancing, but I think this is a big enough move to say at least consider it. Talk with your advisor. If nothing has changed, perhaps it makes sense to rebalance. Okay, number two, the allure of upside with little downside. This is within all of us. We love this. And Peter, there's so many products, catering to this idea that you can get upside in the stock market and limit the downside, or there's new products now promising no downside. And we're seeing a lot of retirees buying into these funds, huge inflows this year, $31 billion into these funds in the last 12 months. Their total assets are at 120 billion now. And there's two types of these funds. You have like an equity premium income, which is simply selling covered calls, so kind of capping your upside and getting more of your return in terms of dividend income versus capital appreciation. So limiting the upside, getting more return in terms of income. And the other one really seems to be exploding of late is what they call buffer funds. And there's many different ways that they structure these things, but essentially it's capping the upside at a certain point and limiting the downside either 100% or some partial percent. And there's a lot of different ways they do it. One they talked about in this article in the Wall Street Journal is there's this ETF now where you can get a maximum gain of 9.8%. So this year with the S&P 500 already up 20%, you would be capped at that level. But if the market were to go down over that 1 year period, well, they're saying it's going to protect against 100% of the losses. I guess they're essentially buying put options to protect about structuring it with derivatives. What do you make? Now, of course, the downside is there's higher fees, complexity. Do you think there's any case for an average investor to be thinking about this? I know that there's a temptation to do it, but what's your view of these products overall?
I think these products play to like the biggest fears investors have, which is people have these fear and greed, right? And so I'm scared I'm going to lose my money. I want to get a big return. Well, here's your magical product that you're going to get a big return, 9.8. Look how amazing that is. The stock market averages 8 to 10 every year. You're going to get 9.8. What's to argue with that? And you can't go down. It's amazing. So it just plays to every emotion investors have. It's got to be the easiest thing in the world to sell. I don't like them at all because the math behind how they works is largely misunderstood. So one of the issues, the reason that these companies can make a lot of money with these products is the stock market, if we're running a projection, we might say the stock market's going to go up 6 or 8 or 10% a year. That's not what really happens. The market goes up 3 out of 4 years, down 1 out of 4, but it's never 6 or 8%. It's up 20, it's down 14, it's up 32. And the people putting these products together know this, and it's in their math, right? So in a year like this year, where if we close today, the market's up 20%, you're only getting 9.8, right? That's a big problem impacting your long-term rates of return because 1 in 4 years, the market's going to be negative. 3 out of 4, it's going to be positive. A lot of those positive years are very, very big years. And if you remove those from the math, you get more bond-like returns than stock-like returns. So this product has to buy derivatives, charge a higher expense ratio. Some of these products pay commissions to the advisors that sell them. All these things can somehow work out because you're the one paying for it all. You just don't notice it. You've been sold upside and security, but in reality, you don't realize how much upside you're giving up.
Yeah, a lot of complexity built into these products. And as you said, if the market were to work where you get 10% every single year guaranteed, well, sign me up. This is a great product. If the most it can go up is 10% the market, and when it goes down, I'm going to eliminate 100% of the losses. That would be great. But returns tend to be lumpy. We're seeing that this year. And more than that, I think it's just the complexity. When things go bad for these types of products, people have no idea what they own. A much better view in my view would be to say, if you're worried about that downside, well, then you need to increase either your cash holdings, your bond holdings, your holdings that don't fluctuate as much. And we don't have a long history. That's the other issue with these products. But Morningstar just took a look at the last few years of data from some of these products and compared it to a 60-40 portfolio of stocks and cash. And not so probably surprisingly, they underperformed that portfolio, which is extremely simple, right? Now you know exactly what you have. The 40%, is it sitting in cash? Here they're using treasury bills. Well, now you're guaranteed to get whatever that current income is. It's not going to go down if it's in treasury bills. The stock side will fluctuate, which is how these products work. But you add in fees, 70 basis points, 100 basis points, or even higher for these things, and you're going to get that lower return. And again, this is a short period of time. I suspect if we look back 10 years from now, we'll see this gap widen even further. But I think the other part of the demand for this, Peter, is the fact that the bond side has been so bad, like we talked about in the rebalancing. So they're selling this product as kind of a bond-like alternative, but it really isn't behaving like a bond at all, is it?
No, not at all. And so I'm just not a fan in any way, shape, or form. Very complex, very high fee, very tax inefficient, and a much more complicated way to get to a place you can get to in a much easier fashion.
Yeah, when in doubt, simple is better. The other, I think, inherent thing within all of us is we think that if there's something more complex, perhaps it's probably better. That might be true in some areas in the investment world, definitely not true. And when an investor doesn't understand something, they can't stick with it, which I think is the biggest problem. And come tax time, we discuss taxes, but if you have a portfolio of stocks versus these funds, you're going to look at very different tax outcomes, definitely not tax efficient the way they're running a lot of these funds. So view that as well. We're not comparing after tax returns, but if we do that 10 years from now, I suspect the gap is going to be even wider if we consider that. Okay, here's an interesting question. Where have all the good stocks gone in the market? And there was an article in the journal comparing the number of funds, Peter, since the 1990s to the number of stocks. And you can see moving in different direction. A lot more investment funds that invest in stocks and a lot fewer securities today. And they talked about a lot of the different reasons for that. Low interest rates, private equity taking a lot of the companies out of the stock market, and just simply startups waiting longer before they go public because they can get access to capital in the private market. And this is a funny one. The Wilshire 5000 index that people often talk about only has 3,381 members in it. And great stat here. There are now close to 3 times as many stock funds as there are companies. And 70% of the world's market cap is in the US stocks, largely concentrated in the biggest stocks, but fewer than 10% of the listed companies in the world are actually in the US. What do you make of this? Do you think this is perhaps a reason for investors to look at the private markets? I know that you're a believer in private equity. Is this a reason for that? Because companies like SpaceX simply aren't going public until a much bigger valuation. They're already at 200 billion in terms of valuation. If this was 20 years ago, they probably would have been public well before this point.
Yeah, I think the world has changed a lot in the last 10 years. And I think that far fewer companies are going public. Part of it is all the regulatory requirements. You might have a company that's getting bigger, and used to be the only way they could raise money was to go public. So they put up with all these quarterly calls and all the regulatory requirements, and investors looking at things quarter to quarter and having to make quarter to quarter decisions. They'd much rather run their business without all those requirements and without having to worry about what's happening this quarter. They should be more long-term oriented, making decisions based on 1 year, 5 year, 10 year. But if you wanted to raise money, you had to go public. Well, that's not how it is today. Now there are private lending funds that are happy to lend you private money. If you've got a good business, you can stay private longer. You can sell part of your business to private equity so you can stay private longer. Private equity funds are getting larger. There are now sovereign wealth funds that come in and invest in private businesses. There are pension funds, like Canadian pension funds that invest in businesses. So there are so many more ways for a business to stay private much longer that you're seeing multi-billion-dollar businesses private. That was not often the case just 20 years ago. And that's why we're seeing less and less publicly traded stocks, far more private companies. And so as an investor, you're ignoring the majority of the investing landscape if you're not at least looking at that space. Now, a lot of people don't need private investments at all, but if the count's getting pretty significant, it's something that should be looked at.
So do you think this is something where we should be doing something from a regulatory standpoint to try to change this, to encourage more companies to access the public markets?
I, I just don't think we're going to change it much, because I think that the investors do need to be protected, and the public markets are available to somebody with $1,000. So we have to have very strong regulatory environment. We're never going to get away from the fact that if you're running a public company, you have to disclose things all the time. So every quarter there will be analysts from brokerage houses and investment banks listening to your calls and telling the public if they think the company is going in the right direction or wrong direction, which is forcing this quarterly thinking. And I just don't see a path out of that. And the private markets, you get to avoid a lot of that. And so it's just, I think what we're going to see, though, is as the private markets become bigger and bigger, we're going to see a lot more regulation come into that market, and we might see the same issues there.
So you're saying it's a competitive advantage, essentially, for these companies to stay private for longer. It's in their best interest to do so. They're able to think longer term. They're not suffering from a lack of capital. And so as long as they can do it, why not do it? So, and that makes perfect sense to me. It's just a big difference from like the world we lived in the 1990s. I'm showing Amazon here. Amazon went public, 442 million market cap. It just recently passed 2 trillion today. We're not seeing these types of companies go public below
No.
a billion today, and perhaps it'll be some time, I suppose, before we'll see that again. So just adapting to a different market, accepting that. You and I aren't going to change it, but just interesting. Do you think, last question on this, do you think that it's had an impact? Some people have made this case on valuations in the past decade, where there's fewer companies, fewer quality companies, and that's pushed up valuations, particularly for the biggest companies, companies like Amazon, Apple, Microsoft, Google, etc.
Well, there's no way around it. I mean, people are putting money in the market, and if you've got thousands more companies, it's spread around more. And if you've got thousands less companies, there's less people choosing. If you've got 4 lemonade stands and you've got 20 people buying lemonade, you're going to have a different outcome than if you have 2 lemonade stands and 20 people buying lemonade. And so I think that that's just part of the reality. It's part of why we're seeing multiple expansion, and part of why we see more eggs get allocated to any particular basket. It's not a huge part of why we see valuations where they are, but there is just as much demand for the publicly traded markets, and there's far less supply.
Yeah, interesting byproduct of all this. Okay, number 4, Powerball investing tragedy. This was a sad thing to read about. Wall Street Journal, Jason Zweig had an article about this, talking about a couple, husband and wife. They win the Powerball. They put a good portion of their winnings into a foundation to research and fund and help people with this rare disease that their granddaughter actually died from a few years earlier. And they're not investors. They don't have a lot of experience. They go out and they find this advisor who flies them on a private plane, and immediately is looking at doing something that's not in their best interest, which is buying variable annuities and making big commissions here. Immediately buying 18 million in variable annuities, earning $1 million in commissions. And then they go on to do that again and again. This advisor doing it to the tune, I think, 47 million here, generating over 3 million in commissions. And this is a crazy stat, Peter. By the end of 2011, they had put 28 million into these variable annuities, and 6 years later, that pool shrunk to 26 million, even though the stock market had more than doubled over this period. What's your immediate reaction to this?
I mean, mind blowing, right? I mean, talk about not acting as a fiduciary. I mean, you've got a foundation that doesn't have any tax consequences, and you're using a variable annuity, so negative from a tax, no benefit from a tax perspective. Very high fee, very high commission, poorly structured product. Advisor got very, very rich off this deal, and the clients which is a foundation, got screwed over. I'm not even going to bother looking for other words. And so it's, it's tough. It's tough to watch these things. They happen over and over and over again.
Someone comes to you in this situation. What are you telling someone who comes to you? They're setting up this foundation in terms of the expectation. Obviously, a lot depends on when they're going to use the money and the liquidity factors around it. But what type of portfolio are you thinking about? As like a baseline for someone in this situation.
Yeah, you're talking bonds, that are going to cover the needs of the organization over the short run, stocks that are going to cover the needs of the organization over the intermediate run, and I'd use individual stocks or ETFs, keep those costs low, and then for the long run, you're using some private investments, and the fees are going to be high there, but you're going to have a better expected performance. You're looking at private equity, private lending, private real estate, things like that. There's no place in a foundation for a variable annuity.
100%. Yeah, kind of crazy that this went on, and it went on for years. And fortunately, they seem to rule in favor of this family here, and they awarded them a fund, a lump sum of I think $7 million. So hopefully that will recoup some of the losses for this couple. At Creative Planning, we do things obviously different. We're looking at the client's best interest. And we are offering everyone who's watching this video a free wealth path analysis. And what do you get with that? You get an objective analysis of your portfolio, of your financial plan. Are you on the right path to retirement? And we'll look at things like your estate plan. Do you have all your documents in order, and your tax situation, which is extremely important as well. So take a look for a link in the show notes. $300 billion in assets under management and advisement. We're in all 50 states, so we likely have a location right near you. So reach out today for a call or a meeting. All right, Peter, we're going to end, as we always do, with signal or noise. Two interesting topical things going on today. Number one, I want to just rewind back to a show we did early in the year talking about this big gap between small caps and large caps. And if you remember at the time, it was this crazy situation where the S&P 500 had hit its first all-time high, and you had small caps in a 20% drawdown, which was very rare. Historically, we hadn't seen a gap like that, only a few other times. And a lot of people were saying this was a bearish signal for the market, saying there was weak breadth, the average stock wasn't participating, on and on and on. What we talked about at the time was that the historical precedent was actually the opposite. It actually was a bullish indicator for the market going forward. Looking at these other time periods, you actually saw better returns going forward. And when small caps were weak compared to the large caps, what you saw over the next year was huge small cap outperformance and large caps not doing so bad as well. Now, fast forwarding a few months since that point in time, what happened was on the large cap stock side, it was exactly what we had said. They continued to hit new highs. It wasn't a problem. But small caps went essentially flat until just this past week, when we had this crazy, unbelievable rotation in the markets. And this is what preceded it, Peter. We had the highest ratio of large caps to small caps since October 1999, during the midst of the tech bubble. And this was a chart I tweeted out a day before this huge reversal, showing you the S&P 500 by market cap, the huge spread in returns. The top 50 were up 13% median return, while the bottom 50 were down 12%. And then someone flipped a switch. Yeah. That someone, well, who knows who it was, but it started with the CPI report. We got a better than expected inflation print. The expectations for a Fed interest rate cut in September surged higher. They're currently now at 100%. And that changed all of the dynamics that have been going on in the market for the past decade plus, where we had all of a sudden small caps outperforming large caps, value stocks outperforming growth stocks, international stocks outperforming U.S. stocks, and on and on and on. And this was the most extreme relationship, the situation between small and large. I'm showing you here the 4-day returns spread between the Russell 2000 ETF and the S&P 500 ETF over the last 4 days. 10% spread, Peter, a record high going back to the inception of the Russell 2000 ETF in May 2000. Is this finally a signal that things are going to change for these beaten down small caps relative to large caps, or is this simply noise?
Well, it's a noise. We don't know, but I will say this, that one thing that we do know is gaps close very fast. So I remember in COVID, the market's down 34%. Clients are saying, well, Peter, it's, at 6% a year, it's going to take me, 5-6 years to get back. That's not how it works, right? Whenever the cloud lifts, the gap closes very fast. Same thing when you see growth in value, or large and small, or international versus US. It can go on for months, it can go on for decades, but when the gap closes, it can happen very, very, very fast. That doesn't mean that this is that moment. This could be a false start. We don't know, but we do know that when gaps close, they close very, very quickly. And if you're trying to time it, you're going to lose.
Yeah, we don't know. I agree, but wouldn't this be nice if this
Yes.
was if it ended like this?
Yeah,
If
from
we
your
if we
mouth to
saw
God's ears. That would
if
be amazing, right? If we could have
if we
some normalcy. Yeah, that'd be
if
great.
we saw that, so we're essentially stretched almost to the max. If we look at what happened 7 years following that 1999 peak in this ratio, it was massive outperformance from
Yes.
small cap. So similar to what we showed last week, growth versus value. I don't know if it's a signal today, if this is the end of this run, but over the next 7 years, I'm going to say this means something, that there's going to be some mean reversion in the markets, and you're going to want to have something other than large cap US stocks in your portfolio. And look what this did in terms of year-to-date returns here, Peter. Essentially flat Russell 2000, now above average year. And like you said, not linear at all. And this gap can be closed very quickly. We'll see if it continues, but up over 12% now, small caps, not a bad year at all. S&P 500 still obviously leading, but that gap is closing in a hurry. All right, number two here, great start to a year. Signal or noise? We have the S&P 500 up 19% through the first 135 trading days. And all of the strategists, Peter, who were bearish coming into the year, all of a sudden very bullish. And they're using this as a reason to be bullish. They're saying strength begets strength. This is a reason to be extraordinary bullish about the back half of the year. Do you agree with that sentiment? Do you think there's a signal in terms of the strong start to a year?
I think there's truth to momentum, but also when the momentum ends, it ends abruptly. So I'm still putting this in the noise category. I do think it's pretty funny though that every of the top analysts, 100% guessed below where the market is today. If the year ended today, it would do better than all the analysts predicted. Many of them had negative outlooks. Imagine following an analyst recommendation that you should be out of the market at this point, coming into the year, and now you should be all in. I mean, talk about a reason to be very tentative about the advice. I'm curious your take.
So my take, just simply based on the data here, and yes, I agree, momentum exists, but I think people use that concept a little bit too much in saying that recent returns are repeatable when they're at just huge extremes. So yes, momentum exists, but also when the rubber band is stretched, we tend to see mean reversion. So I've just looked historically when we've had the 20 best starts to the year. We're at 11 here. So what happened for the rest of the year? The median return wasn't down, it was up 4%. But how does that compare to all the other years? It's almost exactly the same, up 3.9%. So nothing magical you should be expecting. That doesn't mean stocks can't continue to go up. It seems like the median expectations should be some more gains, but you can certainly see a few years in there with some red numbers in there. Like, of course, 1987. When I tweeted this out, everyone's like, 1987, 1929 are on this list. Dun, dun, dun. This is going to be like ignoring obviously the other years where the market did okay. But so I'm going to say this is noise, as with most short-term performance metrics. Don't be expecting another 18% in the back half, but it doesn't mean stocks have to go down a lot. But I would just caution investors, anytime you go a long period without a correction, without a pullback, you should be expecting it. You should be prepared for it. And we've had a very smooth market this year. We had that one brief 6% pullback in April. Market shot right back to all-time highs after that. But since then, it's been smooth sailing, and that's just not the way typically the markets work. They're going to come back and hurt you at some point in time. Because if they don't, then there's no upside, there's no reward. And if we look at the S&P this year versus the average year, you can see the green line there, a little bit above, right? So the total return basis, we're about 20%, and the average year at this point in time, we're up 6%. So that's great. Count your blessings. If you're coming back to that rebalancing situation, this doesn't seem like it would be a bad time for you to think about rebalancing, giving all of this data that we talked about today, especially in that large cap U.S. growth stock portfolio that has had just tremendous gains. All right, Peter. With that, we'll end it right there. Thanks, everyone, for joining us today on Signal or Noise. If you're watching this on YouTube, hit that subscribe button, hit that like button, leave us a comment. I read all of the comments, try to respond to as many as I can, and we'll see you next time on Signal or Noise.